Hey guys, welcome back to the channel. Montana here, and today's video, I'm going to be talking about how to understand trends and what trends are all about. Doesn't matter if you're a beginner or advanced, this is good stuff that you should be knowing. Now, what's so important about trends is, again, twofold, like I've been saying a lot of times. If you're already in a position, or if you're not in a position and looking to be going in. If you're already in a position, let's just say you're going long and you're getting higher highs and higher lows, then you're in an uptrend. Let profits go. You want big runners. You want to be getting consistent trades, but you also are definitely not going to be saying no to a few home runs every now and then. And if you're getting a good uptrend, let that sucker go. Conversely, if you're looking to go into a position, or if you're looking at a few zones and you have a strong trend that's going against you, just say you want to go short and you have a strong trend to the upside. It's a lot safer and a lot wiser to let that train pass you by and wave as it does, and then catch it in an area where you're going to be able to. But understanding trends, one of the basic and fundamentals. And I don't know, I think this is video number 8, 9 or something like that, maybe 10. I'm still in the basics, but this is something that's going to help you understand a lot of stuff in the future. So let's go into our perfect world of theory and see how trends work. Now, trends are pretty simple. An uptrend is anytime you have a higher high and a higher low, higher high and higher low, right? Price starts here. That's the current swing high. It dips and it needs to break above the most current swing high. So let's just say right in this point in time, let's forget about this area right here. We're currently right here. It needs to break above this swing high for you to have a confirmation that the uptrend is still in effect. And it does. It continues to the upside, and then you get a higher swing low. It starts turning. So here you would see a drop base rally. I've done several videos about that. And then somewhere right around, let's just say, let's bring you back here where price falls. Right around here, you'd get a continuation pattern. You get a rally, base, rally. And then let's just finish up the uptrend by saying it made another higher high. That is a perfect uptrend where you get, here's the origin. You get a higher swing high, higher swing low, higher swing high, higher swing low, and a higher swing high. That thing is going great. It's going up. You want to let that thing go. And if you're planning on shorting and you see this, not something you want to be shorting against. Conversely, to the downtrend, you have the origin. It falls, that's your swing low. Here you're going to get a drop base rally, and then you get a rally base drop. And right around opposing demand, and again, I've covered this in previous episodes. Why do I keep on saying episodes? It's videos. I'm not on CBS. Okay, here you get a drop base drop. But for now, keep things simple. You get a swing high, swing low, swing high, lower swing low, lower swing high, lower swing low. That's a perfect downtrend. Now, I'm not sure if you've noticed, but if you have, good on you, that's impressive, how this uptrend and this downtrend are not the same. They look different. And this is why, and this is because price falls 2.5 to 4 times faster than it rallies. And I'm going to show you that as soon as we get to the live charts. But notice how your uptrend is it's a lot more of a swing. It's a lot wider. It's a lot calmer. It just looks, to be honest, more friendly. But going short or price falling is also fantastic because you make money a heck of a lot faster. It's great. So here you have nice swings, and it's a bit more separated. When price falls, it really falls. And this goes down to what I've said before about on the video about how to read candlesticks, how to understand candlesticks, speed versus volume. Candlesticks represent speed. So by definition, any place where you have gravity, it takes like stairs. It takes effort to go up. It takes effort to go up, and hence it takes more time for you to ascend than for you to descend. Descend is just flat out gravity. Hence why price falls, literally falls through, let's just say, a vacuum of price. But it falls as opposed to when price rallies, it has to climb stairs. So it takes longer for it to go up. Hence why there's more distance between each swing, because more time has to elapse for price to rally. it takes a long time for you to get in shape and like 2 days for you to lose it. Kind of like that. Market's no different. This is what an uptrend looks like with real candlesticks. You have a swing low, a swing high, a higher swing low, higher swing high, higher swing low, higher swing high, higher swing low. You get my point. And then all the way up there. Notice that whenever you get a swing high, this is the area where you have to break. Whenever price falls and then, okay, to continue the uptrend, it needs to make a higher high, right? Again, I've covered this. You get a rally base, these two candles, that's basing, because particularly right here, price closed as a neutral candle. That's video number 1 on how to read candles. That's a neutral candle. Neutral candles, if it's neutral, it's basing. It has no direction. It's going sideways. So you have a rally, base, rally, and the basing happens right before or right below your opposing supply zone right here. Hence telling you it's a continuation pattern. Another video. And this also happens to be the demand zone. And I know I didn't draw them out, but you kind of get my point if you've seen previous videos, where this is the demand zone where if price comes into it, it's going to support price. And then it has to break above the next swing high. And the next swing high is this area right here where you get a rally, base, rally, continuing the pattern, swing high, rally, another neutral candle, rally, base, rally, and so on and so forth. So anytime that you have an uptrend, one, if you're already in it, stay in it. It's a runner. Let it do what it's doing best. That's wonderful. And if you're planning on going short, well, just don't. It's a bad idea. You don't want to short an uptrend. You might catch those little small swing moves, but you might as well get in low and buy low for you to sell high. Catch the trend. Their entire terms for it, trend trading, and all those ubiquitous terms. And it's done by anytime you see a swing high. If price a swing high, price needs to break above that swing high to confirm an uptrend, and then give you higher highs and higher lows. It's as simple as that. It's not complicated. Now let's see what a downtrend should look like. A downtrend, you have a swing high, then you're given a swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. Notice how every single one of those swing highs are lower than the previous one. This one is lower than that one. This swing high is lower than that one. This swing high is lower than that swing high, so on and so forth. And the swing lows are also lower than the previous ones. Not astrophysics, it's as simple as that. If you're, again, already in that position, let that go. If you're wanting to go long in a demand zone, you might have a fantastic demand zone. And that's valid. That's a good area or a good location for you to be expecting price to go up. But trends are also equally as effective and equally as powerful. So if you have a demand zone, or if you're looking in this area, in a certain area of demand where you're wanting to go long because you didn't catch the short, that happens to everyone. And if you're seeing price making lower lows and lower highs, you might want to not take the first touch into that demand zone. Wait for price to do certain things, which I am learning to keep videos shorter. So I'm only going to stick to the topic today, which is trends, but I'm going to cover, price shocks and stuff like that. Beautiful system. But that's what a downtrend looks like. Lower lows and lower highs. What happens whenever price is giving you higher highs, higher lows, higher highs, higher lows? Higher high, that's the most current swing high it needs to break. So at this point, let's just say this hasn't happened yet. Just follow my cursor. That's your swing high. Higher swing low, that's good. So here you get a drop, base, rally. It needs to give you a rally, base, rally in opposing supply, and it doesn't. This is the very beginning of what is going to be either basing. Can we cover that where you get a rally, base, and if it breaks below the basing, meaning if it comes down here, it gives you a drop, and to continue the downtrend, it'll give you a continuation pattern, which is a drop, base, drop, or if it continues basing, then it'll come back down here and then give you a drop, base, rally, and it'll continue going sideways until it either breaks above or below. So right here, That's the very beginning of basing at the very least, or a reversal, because price could not break the most current swing high. It could not make a higher high. Now let's look at what that looks like on a downtrend. And I completely forgot about my pretty little circles. On a downtrend, price falls, and I remember my circles now. You get a higher swing high, a swing high, a swing low, a lower swing high, lower swing low, lower swing high, lower swing low, lower swing high, lower swing low. And then this is what, like, and I alluded to this before, this is your price shock right here. Here's a price shock. Right here, this supply zone, price falls from that area of supply, giving you a rally base drop. And for it to continue this whole entire downtrend, it needs to break the most current swing low, which is this one. And it doesn't. Again, it's either going to base from this area of supply right here, and then continue, basing from this area of demand. So this area of demand and supply until it either breaks below or to the upside, giving you a continuation or reversal. That's all trends are. So now we're going to leave our perfect area or perfect world of theory and go into real life charts. So before I get started on this uptrend, I want to touch back on what I said on price falls 2.5 to 4 times faster than it rallies. This is why. And I'm checking my clock, guys. So I'm really don't want to be going for a whole half an hour. I know you guys don't have the time to watch my ugly face talk for that long. So this was a swing low. This is crude oil, by the way. This was that big COVID fall. So I'm just going to give you a perfect, very simple, non-mathematical example, but equally as effective. It's this large cursor that I'm putting on for you guys to give me a hard time. The swing low is right here. That's the swing low. For price to have traveled to the upside from this low right here on this big red candle, that's that low, the wick, I'm not sure if you guys can see it, right there. For price to have traveled from that low all the way to here, in other words, to the high. So from this low to that high, it took this much time, that many daily candles. This is a daily chart where every candle represents 1 day's worth of price action. It took that long. For price to fall the same distance from that high to this low, look at the time difference. Price falls 2 to 2.5 to 4 times, I'm going to say 2.5 to 4 times faster than it rallies. Why? Physics, math, it's gravity. Hence why candlesticks represent speed. Price travels, if you go with gravity, price travels a lot faster. Anything travels faster with gravity than going against it. I bet you anything that if a rocket ship going away from Earth into space goes a lot slower with a lot more effort than a rocket ship plummeting to Earth with gravity on its side. That's what price is. Speed of price. Beautiful thing. So that's my representation. You can easily see this is about at least probably 2.5 times greater or longer than the fall. So let's go into trends. This is, again, crude oil. It's just a really good uptrend. You have swing lows, and the swing highs that it needs to break, right? So you have the first leg, and then you're giving a swing high because it's the origin of this, multi or midterm downtrend, right? This short-term downtrend. And then you get another, swing low to the upside. Notice, and this ties into what I said before in continuation patterns. If an uptrend is to continue, you are going to need continuation patterns. And continuation patterns almost always exist in areas of opposing supply. This is why. What's going on here is, and it ties back to the video on transactions, right here, because price is staying here for a long period of time, the market, or buyers and sellers, particularly buyers, have more time to eat away at the overwhelming amount of, amount of sell orders that exist in this area. If you're in an uptrend, you're going to get rally-based rallies, which are upward continuation patterns. Period. You're going to get them. This is by default. I've said this before, and I've said this, I think, in almost every single video I've put out. Price is a mechanical function. It has to work by certain rules. Flat out. Here you are given swing low, swing high. So now you're going to need to have a higher swing low which means price is going to need to start reversing above this area and then break above most current swing high. How does it do that? With a rally, base rally. You are now officially in an uptrend. So now you just wait for price to come back down, and it's going to need to break this current swing high. How does it do that? By this whole rally base, or even by a shorter term, rally base rally, where in an area of opposing supply. Swing high up here, you get your drop base rally reversal pattern right here, also a reversal pattern. Also this, also reversal pattern and also reversal pattern. Check out the reversal pattern videos. It really does help. They tend to work really well. And a rally base rally, that rally base rally existed right below an area of opposing supply, right where it should. And then you just continue to the upside, where you get just higher swing highs, higher swing lows, all the way to the upside. Now, I'm just going under an understanding, or I'm going over an understanding of trends. I'm going to be going over trend lines soon. But again, let's go over the fundamentals. Let's not jump ahead too far. If not, I'm going to lose you guys. There's a lot of different ways to draw trend lines. Trend lines are not like supply and demand zones. Supply and demand zones, that's cold, hard math. 1 + 1 = 2. Trend lines are a lot like 1 + 1 = fish. It's completely subjective. You can draw a whole bunch of trend lines with all different kinds of angles and all different kinds of places, and it's a lot more of an, well, trading itself is an art-based, is a science-based art. Trend lines are even more so. So there's kind of a few ways you can get into this. You can go for long-term passive investing trend line, which you just go from the lowest, the origin to the next, or to the most current swing low, and then you're given this whole thing. But then you're giving up a whole lot of profit potential. It's really nice. Let's just say you bought in here to sell high and then buy back low and sell high again. That's ideal, right? But if you're a bit more passive, you don't have time and stuff like that, then that kind of easy trend line, that's good. That's not bad. It's fantastic. If you're a bit more active, then you're going to want to draw a trend line that's a bit more like this. Again, still gives you space for price to continue, but it is a bit more aggressive than this. And why these 2 points? I'm going to be covering that. I'm taking a lot of self-discipline to not go off into the weeds. You would have cashed out here, and also notice that the second this swing low, here you're given a swing low, that's your high, it could not make another high, and then it not only does not break another high, but it breaks a swing low. That's your cash out moment. That's your big time cash out moment. Your last breath of maybe it'll come back is this trend line. But guys, don't even wait for that. Just when it breaks the zone, get out. But that's only if you are working with this trend line here, which is if you're a very active trader. Again, we'll be going over different kinds of trend lines for different kind of people, different strokes, different folks. And you would have gotten out high, which is where you want to get out. This one you would have gotten out, you would have gotten cashed out right around here. And then I'll go over, again, if you cash out, you tend to cash back in. And we covered this exact same drop base rally, I think, on last episode. It's almost the exact same location where you would have cashed right back in for a long. There's no coincidence. Price is full of patterns because it's based on math, because it's a mechanical function. It's beautiful. Okay, so that's a quick tidbit into the trend lines. We're going to be covering that. I'm going to go over everything you need to know about trend lines. But today, let's just get an understanding on trends. So that's an uptrend. What does price look like on a downtrend? So I'll take you guys back to, again, the COVID fall of crude oil. Big drop, literally $70 to about 10. Actually went down to 6. That was one heck of a fall. But here you have all the opposing demand zones right here. 1, 2, 3 on this leg, where no coincidence, you get a drop, base, drop, base, drop, base, drop, base, drop, all in areas where you should be seeing drop, base, drops. In areas of opposing demand. And then when you get this is your origin, your swing high, that's your swing low, that's your next lower swing high, and it breaks the opposing swing low, thus telling you, man, you're doing great. So one, if you're seeing drop base, drop base, drop base, drops, you don't want to be going into any one of these zones. You want to wait for that price shock that I mentioned. So if you're looking to go long, price is telling you everything you need to know to just don't do it. It's a bad idea. Instead, go short. Go short where you have fantastic areas of supply. That should be red. And I covered this, I've explained this one before on continuation patterns because it is a base drop continuing to the downside. Hence why price areas and enters an area of supply, continues to the downside, and it breaks swing low, you know, with drop, not quite drop, base drop. That's more of an advanced candle. But here, swing low, drop, base drop. And anytime, again, pockets of air, the very last video I went over, once you start, let's just say that you got in, you shorted up here and you're riding this thing all the way down. Once you see this big ballistic movement and you're approaching, I mean, you're practically approaching zero. It's not going to go much lower than that. If you would have done this, have a passive investor's downtrend, then you would have shorted here, you would have exited here. You would have left a lot of money on the table. You would have exited at 35 instead of exiting somewhere like this. That's a more aggressive trend line, but equally as effective. You would have exited at about 17.80, 18 bucks instead of 35. Huge difference. That's a lot of money on the table. Times however many shares or times your share size, money. You don't want to be doing that. Trend lines are a beautiful thing. But you need to understand trends first. So you want to be seeing higher swing highs, lower swing lows. Swing high, swing low, lower swing high, lower swing low, and so on and so forth. And anytime you get ballistic movement, a pocket of air, cash out at the bottom of it if you're going short. One last thing before I let you go, another small piece of candy is there is no coincidence that this origin of this supply zone is beautifully synchronized with this trend line and with this trend line break. So you have a rally-based rally just on supply and demand alone, and it also happens to have broken that trend line. Why? It's something I'm going to be going over soon. So I hope this helped you understand uptrends and downtrends, how they should look and what they should be doing. If you're already in a trend, let it go. And if you're wanting to go in counter, which is what you should be doing every single go. If you want to be going short here, then you need to be having price go up for you to short. So if you want to go counter, which is again what you should be doing, you need to be aware of what price is doing as it's approaching your zone. And if it's continuing, if you have a strong trend against you, let it go and catch the trend at a higher or lower level, depending if you're going long or going short. All right, guys. See you all in the next one.